Hello, are you confused by all the different types of loans out there? What is an asset-backed loan versus a cash flow loan? What will it cost? Do I need to have collateral to get a loan? And what if my bank turned me down? Can I go to other lenders? If you are a small business generating $2 million or more in EBITDA, this video is specifically for you. If you're making less than that, there are certainly financing options available, but what we're going to discuss today may need to be modified to be relevant to your particular situation. Here's the thing, there are a lot of debt products out there, and many of them can get quite complex. So today, we're going to simplify it down and give you a clear framework for understanding your options as business owners. By the end of this video, you'll understand the categories of lenders you can work with and key types of loans available to your businesses so you can make informed decisions about financing your growth. There are over 8.2 million businesses in the US, and only 7% of those businesses are large enough or growing fast enough to attract the attention of private equity or venture capital. My name is Aaron Yu, and I spent the last 20 years buying and selling companies, first on Wall Street, then in tech. I've used debt to buy companies from Qualcomm, Disney, and Goldman Sachs, and I can help you understand the intricacies of this aspect of finance. So let's dive right in. First, let's talk about who you can borrow from. To simplify, we can divide the world into two, banks and non-banks. This distinction is more important than you might think, and you're going to understand why in a moment. When I say banks, I'm talking about financial institutions that take in deposits in the form of checking accounts and issue loans as their primary business stream. Banks, by definition, hold a charter that's issued by the Office of the Comptroller of the Currency, that's the OCC. This includes credit unions, savings institutions, and thrifts. This charter gives the bank the ability to hold onto your money in a depository account, meaning a checking or savings account. Because of this aspect, banks have access to very cheap capital. They don't pay you very high yield on your savings or checking account. Hence, when banks lend out money to borrowers, their rates are lower than non-bank institutions. For a comparable quality company and similar debt structure, a bank loan can be 200 to 1,000 basis points. That's 2 to 10% lower than a non-bank option. In exchange for this cheaper cost of capital, banks will have stricter underwriting requirements. What's the easiest way to tell if a financial institution is a bank? Go to their website. You'll see a logo that tells you deposits you keep at that institution are insured by the FDIC. What type of banks are we talking about? First, the national banks you already know or have done business with, JP Morgan Chase, Bank of America, Wells Fargo. Next, you have regional banks like City National if you live in California, or Fifth Third if you're in Ohio. Then you've got local banks like Nevada State Bank, where I live, and don't forget credit unions like Actors Federal Credit Union or Silver State Schools Credit Union. Finally, there are online banks which predominantly provide their services over the internet with little or no branch presence. Charles Schwab is a good example of this. Now, non-banks are lenders that don't take deposits. They can include private credit funds. These are funds that have sprouted up to provide loans and have become the bank's largest competitors in the middle market space. Commercial financing companies that do specialty lending such as equipment financing. And there are family offices, which is a fancy word for an investment group formed from one person or family's personal wealth that's dedicated to investing that family's money. Note that this is not a holistic classification of all types of non-banks, and keep in mind these labels themselves are quite broad. For instance, there are many different flavors of private credit funds that can be quite nuanced when you get into the weeds. The important thing to remember about non-banks is this: they do not take in customer deposits. They are spread lenders, meaning they make their money by arbitraging a spread between their cost of capital in the wholesale market versus what they lend to you in the retail market. As a result, non-bank lenders charge higher interest rates. The advantage of using a non-bank lender is this: they have more flexible repayment terms, often delaying or deferring the principal payment for a period of 1 to 4 years from the date of origination. Their financial covenants tend to be more lenient. Most lenders utilize one or several of the following types of covenants to monitor the financial health of its borrowers. 1. A leverage ratio that is expressed as debt divided by EBITDA. 2. A fixed charge coverage ratio that examines how many times can the cash flow of a business cover the annual interest, principal, tax, and capex payments. 3. Some measure of liquidity. Finally, non-bank lenders have a wider aperture in looking at companies or industries that banks may have turned away. Now let's dive into the 5 main types of loans available to small businesses. I want you to understand how each one works and what lenders are looking for. We will not be discussing SBA loans in today's video. The SBA 7A and 504 loans are very unique loans that are available to small businesses and can be very attractive. However, there are many factors at play that will determine eligibility for an SBA loan. First up, asset-based lending, or ABL. This is often the first type of loan that small businesses tap into. It's intuitive and easy to grasp. Many businesses make a pit stop here before advancing into more sophisticated loan types. Honestly, ABL is easier for lenders to underwrite to as well. The A in ABL stands for assets like the following: accounts receivable, abbreviated AR, finished goods inventory, work in process inventory, and equipment, which can range from production lines, fixtures, to machinery, to vehicles, to servers, and a host of other items that fall in your PP and E line. Your business might have some or all of the assets I mentioned. The basic formula to determine how much a lender will lend you is to take the asset value, subtract out the ineligible amount, then multiply it by an advance rate. For example, let's say you have $1 million of AR. The lender determines that $200,000 is ineligible AR. That leaves you with $800,000 of eligible AR. The advance rate is 80%, so you can borrow $640,000 on the $1 million of AR. I call this the net advance rate. The key takeaway is there are 2 haircuts that a lender will apply. The first being the removal of ineligible assets, which can be due to a variety of reasons, like the receivable has aged out or cross-aged. Second is the advance rate on the remaining eligible asset base. The same mathematical concept applies to inventory and to equipment, but with decreasing advance rates as the asset becomes more liquid. Advance rates for AR is 70 to 90%, 40 to 60% for inventory, and lower advance rates of 20 to 40% for eligible equipment, except when going to a specialty equipment financing firm, which we will discuss in a later section. ABL is commonplace amongst both banks and non-bank lenders, with non-bank lenders being more generous on what they deem as an ineligible asset and the advance rate, so that a borrower can borrow more against the same dollar value of assets. Now you might be asking yourself, but what if I don't have any assets on my balance sheet because my business is a software or service business with no real assets? That's where cash flow lending comes into play. In cash flow lending, lenders are looking for companies that can reliably generate cash flow over time. The cash flow is the lender's primary source of repayment, so they will evaluate a borrower quality based on operating income, EBITDA, EBIT, pre-tax income, or some other equivalent metric. While both banks and non-banks do this form of lending, banks have moved their size thresholds up so that if your business is not generating at least 2 to 3 million in annual EBITDA or operating income, it will be very, very difficult to obtain a cash flow loan from a bank. The thinking here is that if your business is too small, the loss of just one customer could put your business in a tailspin, and any cash flow used to cover the debt and interest could quickly evaporate. Again, keep in mind that SBA 7A loans are unique in the sense that banks will have lower thresholds for those loans. At the time of this video, the average range that you can expect to borrow for a cash flow loan from a bank if you meet their size threshold is between 1.5 to 2 times your trailing 12-month EBITDA. We call this multiple, the leverage multiple. If you generate $3 million of EBITDA a year, expect to be able to borrow $4.5 to $6 million on a cash flow loan. A non-bank lender may be willing to lend 3 to 3.5 times leverage ratio. A cash flow loan can be structured as either a line of credit or a term loan. What's the difference? A line of credit works like a giant credit card, but your maximum credit line may fluctuate up and down. The maximum debt allowed to be outstanding, or capacity as we call it, could be a moving number that is predicated on recent cash flows if the line of credit is what we call formula-based. Note, there are some lines of credit that are not formula-based. A term loan's debt capacity is set at the time of underwriting, and the company will receive all of its loan proceeds in one fell swoop at closing, which it will subsequently repay over a course of 3 to 7 years. You might be thinking, wait, does that mean that with a line of credit my debt capacity can go down if I have a bad year? Yes, 100%. If you have a falling business and now you are overextended on the debt capacity, the lender may require you to pay down a portion of the loan to bring it back in line with the leverage multiples at the time of underwriting. This will put you in the unfortunate position of not only having to deal with a business downturn, but you will at that very moment have to come up with the cash to pay down the loan or risk a default. For this reason, I advise that the superior structure 9 out of 10 times is the term loan structure, if you can get it. Let's now talk about equipment financing. It is technically an offshoot of asset-based lending because a lender is still extending debt based on the value of the asset. But equipment financing is a very special form of ABL because different companies have such unique equipment to carry out the business functions in their industry. As such, you often see commercial finance firms that specialize in just one type of equipment. Other times, you might see a bank engage in equipment financing for certain assets like trucking, but not others like farming, because every type of equipment has a different resale market and liquidation value attached to it. It often takes a specialist to be able to truly value the equipment. Thus, your best bet will be to find a lender who has done a lot of deals in your industry. For business owners out there who own unique assets like servers, networking equipment, or commercial kitchen equipment, you might find that the equipment vendor itself offers financing or has partnered with a financier to lend against the equipment they are trying to sell you. Next, let's talk about mezzanine loans. Mezzanine loans are a derivative of cash flow lending. The phrase mezzanine comes from the feature of these loans, which situates them in between traditional debt and equity. Sometimes they go by aliases such as subordinated loans or second lien debt. There are two defining characteristics of mezzanine loans. One, they sit behind a senior first lien loan in the repayment priority and security priority, whether that senior loan is a cash flow-based or asset-based loan. Two, as you can guess, because mezzanine loans are behind the senior lender and taking more risk, mezzanine lenders will charge a higher interest rate. This will bring their total cost of capital to a number just below equity, typically in the high teens. So what is their advantage? Their primary advantage is that they increase the debt capacity a borrower can take on. Remember how we mentioned that for most cash flow loans, the leverage ratio with a non-bank lender can be as high as 3.5 times leverage ratio. Mezzanine lenders may add another 1 to 2 turns of leverage. There are firms that specialize in this type of mezzanine lending. All of them are non-banks. They exist in the corners of the private credit and family office world that the average person will never encounter. Almost all borrowers who take this type of loan on will have to have a substantial amount cash flow to begin with, likely upwards of $5 million. Finally, many of my viewers will likely come from a technology background, so I'd like to spend a moment talking about venture debt. Venture debt, in its original form, has all but shriveled to a shadow of its former self. When venture debt was first created, it was a type of financing given to companies that had neither cash flow nor assets. In fact, most borrowers of venture debt were losing money, and the only commonality they had was that they tended to be growing rapidly, and they received financial backing from a venture capital or private equity firm. The thinking went, as long as these businesses continue to grow, VC and PE will continue to throw money to fund their operating losses, and we have nothing to worry about. The COVID recession threw a wrench in that lending model, and many of the lenders who did this went belly up. Today, venture lending has taken on a new shape, combining elements of everything we discussed earlier. They are part cash flow lenders, part asset-based, and will even dabble in mezzanine loans. For software companies that don't have any significant cash flow, venture debt sometimes takes the form of a recurring revenue line, which is a line of credit based on a multiple of a recurring revenues. And that wraps our primer on the different types of debt available to businesses. Today, we covered the difference between bank lenders and non-bank lenders. We took a tour through the leverage finance world, making stops in asset-based lending, cash flow lending, equipment financing, mezzanine, and venture debt. If you learned something today, tap that like and subscribe button below. Remember, this video is intended to serve as educational content only. If you'd like to schedule a more in-depth review of your company's specific situation, click the link below to send us a message. Your initial consultation is free. Before making any financing decisions, always consult with your advisors to make sure you're making the right choice for you and your business.